This is Perspectives, a bi-weekly investment podcast brought to you by Escala Partners. In a world cluttered with information, Perspectives cuts through the noise to bring you insights and commentary on global financial markets, economics, and geopolitical news and events.
Welcome to Escala Investment Perspectives. As we approach the end of the quarter, markets are under pressure with uncertainty around how and when the Iran conflict ends, and of course, what the ongoing side effects will be. Diversification is your friend in these markets, and of course, opportunities will emerge. So, joining me to discuss the latest events and more is our CIO, Tracey McNaughton. Welcome, Tracey.
Hi, Ed.
So, Tracey, there's a lot hitting markets at once. The war in Iran, rising oil prices, and central banks all moving in different directions. Equity markets have reacted, but in a relatively ordered way so far. Sure, you have had experiences of riding through oil slicks on your motorbike. So how do you keep your composure?
Well, I haven't hit oil, but I have hit gravel, and that can be just as slippery. And the mantra going through your head is very simple. Stay calm, keep it steady, and most importantly, keep your grip loose. Loose on the bars is what they say. Because the moment that you tense up, overcorrect, or panic, that's when things unravel. You're most likely to hit the brakes, which is exactly the worst thing that you can do, because that then hampers your ability to steer the bike. And I think what long-term investors are doing, and from what we can observe among our client base, Ed, what they are doing quite well is exactly that discipline that you'd want on a bike. Larry Fink, the CEO of BlackRock, he says something similar, even though I believe he prefers push bikes over powered bikes. But he said in his recent letter to clients, speed can distort perspective, crowding out long-term thinking. The danger is that we focus so much on the noise that we forget what actually matters. And I think that was pretty sage advice. Long-term investors know this. They're not gripping the handlebars too tightly. They're not overreacting. They're staying loose, staying balanced, and crucially, they're looking through the corner. They're acknowledging the oil slick. The risk is real. Uncertainty is high, but they're also focusing on where the road leads next. And that's why, despite everything happening, they're holding their line rather than sliding off it. What we are telling clients right now is, yes, the geopolitical picture is messy right now, but the system isn't broken. It's adjusting. We saw this in the past. Over 40% of the nuclear power that we have today was built in response to the 1973 and 1979 oil crisis. In response to the war between Iran and Iraq in the 80s, Saudi Arabia built a 1,200-kilometer pipeline that went from east to west that bypassed the Strait of Hormuz. It was a hedge against disruption in the strait. They're now making use of that pipeline. It is possible in the wake of this event that we will see renewed efforts to transition to renewables. We're already seeing a surge in electric vehicle sales. We may possibly see another boom in nuclear energy. So there is opportunity there for long-term investors, for those that can look through the corner.
Tracey, back in 2022, when Russia invaded Ukraine, the oil price hit over $120 per barrel, and the peak so far is under that. And yet, despite this, the price at the pump here in Australia is higher than it was in 2022.
Yeah, that's a very good observation, Ed, and a painful one for many households and businesses. A big difference between now and then is that in 2022, the Australian government cut fuel excise by 22 cents per litre and held it there for 6 months. It won't surprise you, Ed, to know that the cut in the excise tax coincided with the May 2022 federal election. This time, we are far from an election, and so there is no talk of cutting the excise. And if anything, we are bracing for a potentially difficult budget in May. Treasurer Jim Chalmers wants to accelerate through this corner. He's talking about how this is now the time to accelerate reform. Well, so we'll see what happens on Tuesday, the 12th of May. See what that brings. Anything, of course, can happen between now and then.
So, Tracy, staying on the topic of macroeconomic policy, and the Australian Reserve Bank tightened monetary policy last week, lifting the official interest rate to 4.1%. And that's the second consecutive rise. And it was the first central bank among the majors to respond to the war in this way.
Yeah, that's right. Though the Reserve Bank would say that inflation pressures were rising before the war began, and so it just brought the timing forward. That may be true, but it does make for a double whammy for households and for businesses here. Significantly higher petrol prices and now a lift in interest rates for the second consecutive month. This kind of inflation that we're seeing as a result of the oil shock is generally seen to be destructive for demand. It's not the kind of inflation a central bank should react to, but they are. Other central banks that met last week, those in Europe, the US, the UK, Canada, Indonesia, and Japan, they all left rates unchanged. So Australia so far stands alone, although we should note markets have been moving around quite a lot, and expectations are moving dramatically. So pre the war, the market in the US was positioned for 2.5 interest rate cuts in the US this year. Now, rate cuts have been priced out of the US until December 2027 at least. So we've seen 2- and 3-year bond yields around the world have jumped sharply higher in anticipation of higher interest rates from the central banks.
And beneath all that, the real economy, or at least in the US, seems to be holding up.
Yes, it is, at least so far. We will start to get some economic data tonight. That's Tuesday night, the 24th here. That will start to capture the impact of the war. So we'll be taking a very close look at that. But at the company level, though, we are seeing some signs of resilience. A great example is FedEx. That's a proxy, as you would expect. It's a proxy for global trade. What we saw with FedEx last week was strong earnings, a beat on expectations, and importantly, upgraded guidance. So despite geopolitical noise, the machinery of the global economy is still operating. Supply chains have not seized up. Demand hasn't collapsed. Travel demand too is remaining steady despite the geopolitical unrest. Business travel is still strong. Companies appear willing to look past the conflict. And I was reminded yesterday, Ed, of how the economy is less sensitive to oil prices today than during past oil shocks. When my Woolworths delivery turned up in an electric-powered truck, it sounded like a little Jetsons car pulling up. Woolworths say that they want to be all electric by 2030. Admittedly, it's still early days for Australia, but the point is that it's happening and may actually be accelerated now.
Right, so let's change topic now and talk about AI, because it still feels like the structural story cutting through everything else.
Yes, Jensen Huang articulated this really well recently, and it's worth people listening to him directly. I should say, if you haven't already, the Quarter app is a great way to do that. This is an app that goes onto your phone. It's Quarter, Quartr. It's an app that gives you access to company earnings calls, presentations, conferences, interviews, so you can hear directly from the CEOs and management teams rather than relying on headlines or secondhand summaries. And so Jensen breaks AI into 3 phases. The first phase was generative AI. That was the breakthrough moment. That was ChatGPT, image generation, code. That's what brought AI into the mainstream. The second phase is reasoning AI, models that can think more deeply, solve multi-step problems, and handle more complex tasks. But the really important shift now is the third phase, agentic AI. This is no longer about AI helping you write something or answer something. It's about AI actually doing things for you, planning, executing, making decisions, having a degree of autonomy. And so that's why it's called agentic. It has agency.
So it's moving from assistant to operator. And Jensen's point is that this is bigger than the last wave.
Exactly. And OpenClaw, that's the latest model to come out of China, is an example of that shift. Jensen says every company now needs an OpenClaw strategy, not because it's trendy, but because it's becoming core infrastructure. But this isn't just a corporate story, it's becoming a political story as well. There is a push from the US, particularly from Trump, to make permanent a global ban on digital services taxes. So, in simple terms, that's about preventing countries from taxing large digital platforms like Microsoft and Google, where they operate but aren't headquartered. Mark Carney had legislation ready to go on this in Canada until Trump talked him out of it. The Europeans also have draft legislation. Now, on the surface, it sounds like a trade or a tax issue, but underneath, it's much bigger because what it's really highlighting is an emerging problem for governments. They are trying to tax an economy that is increasingly becoming digital. Robots don't pay taxes, at least not at this stage. So how does the government raise revenue to fund its health, its welfare, and its various other programs?
So AI is forcing governments to rethink how they operate.
Yeah, I think that's absolutely. Just as past revolutions forced governments to adjust, agentic AI is accelerating that. If value is being created by autonomous systems, if work is being done by software agents, if companies can scale globally with fewer people, well, then traditional models of taxation, employment, and regulation start to come into question. And that's why this next phase of AI isn't just about productivity. It's about reorganization. It's about structural change. And governments will need to rethink how they tax, how they support workers, how they regulate digital systems, and how they ensure fairness in an economy that increasingly operates beyond traditional borders. There's growing public concern about whether the benefits of AI will be broadly shared. People are feeling anxious about this. This is why consumer sentiment surveys have us being the most pessimistic since COVID. Whether systems are fair, whether the economic gains will concentrate at the top, these are all things that we're worried about. Every major technological shift has required institutions and governments to adapt. The difference this time is the speed. AI is advancing faster than those institutions and governments can comfortably keep up with. And so that creates uncertainty. And so let me tell you, Ed, a great illustration of this is the steering wheel lock. It is making a comeback. You can now go into a Bunnings warehouse and buy a steering wheel lock again. In fact, it's one of their best sellers. In fact, Toyota has just released its own branded steering wheel lock. That's a piece of technology we all thought had become obsolete. My 19-year-old daughter doesn't know what a steering wheel lock is. She thought it was something to hit intruders over the head with. Cars got smarter, security systems improved, everything went digital. And yet, here we are, Ed, going back to a very basic, visible deterrent. This is the same technology that my canary yellow Datsun 200B used, and that's now being suggested for your brand new Toyota. So why is this happening? Because the threat evolved faster than the protection. Car thieves figured out how to hack keyless entry systems. So suddenly the most effective solution isn't more complexity. It's something simple. It's physical and it's hard to bypass. And that's exactly the moment we're in with AI. We've built incredibly powerful systems, agentic AI, OpenClaw, automation, that can do more than ever before. But the guardrails, the policies, the institutions around them haven't caught up yet. So people start looking for steering wheel locks in the digital world. Simple protections, clear rules, visible safeguards. And it's not because we want to slow innovation, but because we need to feel that it's controlled. Progress, it feels, has outpaced protection. So what happens next, both in cars and in AI, is that systems will adapt. Eventually, the security catches up, the technology matures, the need for the lock fades again. But in that transition period, you always see this pattern: rapid innovation, rising vulnerability, then a push for simple, stabilizing solutions. This is possibly one of the reasons why gold was in such demand up until recently. I'm sure people are burying their cash in a can in the back garden again, just as our grandparents and great-grandparents did. And that's where we are with AI. It's not that the technology is the threat, it's that the system around it hasn't fully adjusted yet. And just like with cars, that adjustment will happen. But in the meantime, well, expect to see a lot more steering wheel locks in policy, regulation, and human behaviour, I guess.
And Tracey, this isn't just an AI story, it's an economic and political one as well.
Exactly. And that's why, despite everything else going on, geopolitics, oil, central banks, this remains the story that matters most over the long run.
Yeah, stepping back, it seems the thing that ties all of this together, AI, the energy shock, the electrification of Woolworths delivery trucks, is adaptation. And a lesson for the wise: make sure you have your lock facing out when you extend your steering wheel lock. Makes it easier to use. Yeah, that's all we have time for today. Thanks for those insights, Tracey. Hope everyone enjoyed the update, and we look forward to you joining us for the next podcast. Until then, please take care and stay safe. Thank you.
Thank you for listening to Escala Perspectives podcast. Be sure to subscribe to this podcast on iTunes. You can connect with Tracey by visiting escalapartners.com.au. Escala Partners is a corporate authorised representative of Escala Wealth Management, which holds its own AFSL. This podcast has been prepared without consideration of specific client investment objectives, financial situation, or needs, and is for general information purposes only. Please don't rely on it for the purpose of making an investment decision. You should seek independent financial and taxation advice prior to making any investment decisions in relation to any of the content considered in the podcast, and consider any relevant disclosure documents. If you require any further information regarding the matters discussed on the podcast, please contact Escala Partners.